Okay, so a traditional pipeline company basically claimed they're the unsung hero of the AI data center boom. That's quite the pivot. Welcome to Earnings Unscripted. It's July 31st, 2026, and we're looking at Enbridge's second quarter, ticker ENB. So, Miro, did they actually pull off this tech-adjacent narrative, or wait, is it just clever marketing?
It's really a bit of both. It's an incredibly solid operating quarter despite their normal seasonal drop-off. I mean, revenue came in at roughly $13.8 billion, which easily beat the street's $10.8 billion estimate.
Right. And yet, the stock still faded after the opening bell and closed down fractionally, which just proves how weird earnings reactions can be. So please remember, our takes on the market are just personal opinions, definitely not financial advice. But why would sellers step in if the actual business looks so strong?
Mostly because they're carrying an incredibly heavy balance sheet right now. Adjusted EBITDA was solid, hovering right around $4.8 billion, but management's sitting on a massive $41 billion backlog of secured growth projects. So investors look at all these blue-chip AI power deals and immediately ask how Enbridge actually plans to pay for the plumbing.
Well, the literal plumbing here is actually fascinating. I loved that note from the utility side about gas storage. They bought up cheap natural gas, packed it into massive underground caverns, and just completely bypassed peak winter pricing. They saved Ontario customers roughly $200 million doing that. Like literal underground hoarding paying off.
Yeah, they have to highlight stories like that because internal polling shows their utility customers feel flat out angry about the cost of living. It's political armor, honestly. They need regulators to view them as the good guys fighting inflation, especially while they're asking those same regulators for base rate hikes in places like Utah.
Which brings up the weirdest detail in this whole report. I was looking at their Mainline optimization plan, and it looks like they're deliberately disaggregating the project to build the downstream U.S. portions first, just completely leaving the upstream part hanging. Why would a company intentionally build a lopsided pipeline?
Because they literally can't wait for politicians up in Canada to make up their minds. They're actively disaggregating that Mainline optimization project and building out the Chicago South portion first.
Okay, wait. So they're basically building the exit doors before the actual building is finished?
Essentially. Gulf Coast and Midwest refineries are incredibly hungry for heavy crude right now, so Enbridge can lock in an immediate return by fixing that bottleneck down south. But up in Canada, the government and the producers are still sitting at a non-binding MOU stage.
Mm-hmm.
Colin Grunding, the head of Liquids, actually called this out on the call. He said, there's an order of operation, right? Production policy, production pipelines.
Well, that's an incredibly polite way of saying the government needs to get its act together.
It's just extreme midstream agility. They're accepting a slight temporary system imbalance in the U.S. rather than freezing capital and waiting for the Canadian side. But that agility does have a cost, especially on the balance sheet.
Right, because their trailing debt leverage hit 5.1 times this quarter, which seems high considering we just talked about all those massive infrastructure projects they're juggling.
Yeah, their target is a range between 4.5 and 5 times. The CFO, Pat Murray, pinned that miss on an unfavorable Canadian to U.S. dollar spot rate right at the quarter end. His actual quote was, adjusting for this FX impact, debt to EBITDA would be within our target range, which is fair accounting, but it kind of glosses over some very real, unmodelable capital drains coming down the pipe.
Okay, what kind of drains? You mean all those hyperscaler energy builds we mentioned?
No, I'm talking about straight-up legal defense. They just sanctioned a $1 billion project for the Line 5 relocation over in Wisconsin.
Oh, hold on. Let me just pause there for a second. Walk me through that again. Why exactly are you spending $1 billion moving a pipe that already exists and works perfectly fine?
Because a federal judge literally ordered them to. Back in 2023, a court ruled they were operating on an invalid right-of-way crossing the Bad River Band's lands. And there's a hard, non-negotiable deadline attached to that. They have to completely cease operations on those specific lands by June 16th, 2026. So This isn't some optional growth strategy to court data centers. It's a defensive scramble.
Wow, so they have a literal ticking clock from a federal court to keep one of their most important regional arteries open?
Exactly. And that's just the Wisconsin part. The Michigan Attorney General is still actively trying to get the rest of Line 5 shut down, and everyone's just holding their breath waiting on an appeals court decision.
So you're carrying this enormous growth backlog for tech giants while simultaneously scrambling with billion-dollar defensive outlays just to survive local court orders? How does a management team even balance capital allocation with that many completely opposing forces?
They basically play a massive game of temporal arbitrage. You delay what you can, like the Canadian side of that pipeline expansion we talked about, and you pull forward the surefire returns down south to fund the defensive stuff.
Which sounds completely exhausting. But I guess that explains why they're leaning so heavily into those safe-harbored renewable projects right now.
Right. They secured early tax eligibility for those builds, which de-risks the capital outlays while they wait out the regulatory fights. And management actually seems totally comfortable with this balancing act because they just reaffirmed their full-year guidance.
Okay, wait, did they stick to the original outlook?
Yeah, they kept the adjusted EBITDA target right around $20.5 billion for the year. They also reiterated that roughly 5% growth trajectory going forward.
So they're projecting stability even with all these spinning plates. But looking ahead, what's the actual tell? What are you watching to see if this balancing act holds up?
Honestly, I'm watching their debt language. They missed the leverage target this time, and while they blame the exchange rate, I want to see if that multiple actually drifts down or if the debt just keeps climbing to fund all these new data center connections.
Right. So if we hear the phrase near the top of the range again next quarter, the market might start getting slightly nervous about the dividend.
Exactly. Look, it's an incredibly durable business, but gravity applies to everyone's balance sheet eventually.
Gravity applies to everyone's balance sheet. We're definitely putting that on a t-shirt. I think that covers it.
Always a pleasure. See you next time.
If you like getting these numbers translated into normal English, tapping follow on your app's a great way to catch our next episode. And just for full transparency, this entire podcast, voices included, is completely AI generated, letting us process Enbridge's massive growth backlog and get this conversation into your feed on the very same day. We'd love to hear your thoughts or what ticker you want us to unpack next, so send a note to earningsunscripted@datamadness.ca.
Catch you next time.